We are in an unusual time frame. There's no doubt about it. You can look at the statistics. You can see what's happening in the markets, the economy as well. Everything is really coming to a tipping point, if you will. And I think it's important people understand what's happening really underneath the hood, because if you're just reading the headlines, you're never going to know what's happening in reality. The first thing I want to talk about is the economic headwinds that are going on today. That'll be a short part, which will lead into the second, which is charts galore. I like to call it the chart GPS. We're going to talk about what's happening all over the place. I got a lot of stats for you. The third thing is the real estate madness. I'm going to cover that on 2 different levels. I've got all of that and more. Let's begin. I'm sure you've seen this yourself, or maybe you've been reading about it. US food supply is under pressure from plants to store shelves. All over the place, I have noticed. And remember, I get data not just from the articles and the charts and so on, but I hear from people literally in every country around the world. It's unbelievable over these 10 years. And I have seen some places suggesting everything is fine, status quo, business as usual. And other places are saying, I went to go buy that product and I looked everywhere and I couldn't find it. And it depends if it's certain types of produce, or maybe it's a certain type of other product that people need, that people want, and they can't get it. And what does that mean? It means as the supply dwindles in the area, the price can go higher. That could be a concern if it's not the latest iPhone, not if it's a laptop. I mean, we're talking about basic essentials. This is a concern. This is a problem, of course, because as you see the prices getting higher on essential goods, this puts a strain on the economy as a whole. And you could see the in-stock levels of selected products in US retail stores. So they just gave you this breakdown over here as part of the Wall Street Journal article. And as always, links in description. Fresh eggs, all edibles, frozen meat, poultry, so on, sports and energy drinks, and then refrigerated dough. It all depends on where you look. But the point here is that people are seeing less of what they want. You could, look at the data, look at the charts. It's all anecdotal evidence, in my opinion, that's really important. So if you want to check out the article, it's there for you. It's really here to set me up into what we'll talk about in a second here. The supply chain disruptions delay the normalization of durable goods prices, which would keep inflation higher this year. If you look at what has, been predicted over and over and over again, yes, inflation's bad. Yes, we were completely wrong about our forecasts, but let me tell you something. In the next little while, that inflation is going to start coming down. I know we were wrong month after month after month after month, but trust us, this time around, we're going to be okay. We're going to do it right this time. Sure. And then you can see the breakdown here. Other goods, travels, supply constraint, other services, shelter, and so on. Yes, don't worry. 2022, early on, we are going to see that subside. The question here is that while the Federal Reserve is anticipating hiking rates multiple times this year, you've seen that. That's the anticipation. Well, then why is it that there's going to be this forecast of a reduction in all the different measures of inflation throughout the period? Are they going to still hike those rates? Should inflation, come down? What's going on? There's a disconnect, and we need answers. All right, the chart GPS, this is what you came for. I'm going to go through these quickly, but I want to give you some good detail as much as I can. Of course, I'm not going to read every little piece of every data. It's always in the description, but I'll give you some good stuff. Data have disappointed expectations recently, indicating slowing growth momentum. This is just the US Economic Activity Surprise Index. Essentially, what we look at here is the expectation of something. Does it come out better or does it come out worse? And often, right now, at least over the past couple months, it's been worse. I've shown you the stock market, and maybe I'll show you more in a second. Highlighted this 100 times before. You are looking at early November was the point at which I'd been yelling and screaming, saying this looks bad, like bad news. And it's been weak ever since. And so many of the different indicators were popping up. And I was especially in this period here, I think I was still doing the lives at that point, and I remember mentioning it, that's for sure. The conviction just wasn't there. You could definitely see that. Now, this happens to be the S&P 500, but I mean, if you look at it with, this is the Russells, the small caps, I mean, it has been very clear that the conviction had completely disappeared as we were in that point in early November. That was obvious. That was obvious. Even this little bit of a rally in here, it just didn't have it. And you can go further back and look at this. I mean, if you were in small caps while they rallied massively up until the point in early, well, that's February 2021, it's just been chopping for 1 year, chopping up and down, up and down. So there's an opportunity, perhaps, if things, the market essentially, what are we looking for? Okay, let me just be very clear. What are we looking for? Well, this is a chart showing us the Federal Reserve's balance sheet. And what we need right now, what the market needs, is the expectation of, we're not going to go so hard. We're not going to go so strong. We're not going to be so hawkish, as they like to call it. If the market gets that, the market gets what it wants. And ultimately, I think as of Wednesday, when the statement comes out, and more importantly, when the Federal Reserve does their, or Jay Powell specifically, does that little conference with the reporters after, that they get a little bit more insight, and he's going to be very soft. That's at least what the market wants. We expect the Fed to shrink its balance sheet from $8.8 trillion to around $6.1 to $6.6 trillion over 2 to 2.5 years. And that just gives us a little bit of, how long it will take to start wearing this down. But think about that. It is still over $6 trillion on the balance sheet in a time when they told us from the previous cycle that they would get rid of all of this stuff. And yet $6.6 trillion in over a few years. I mean, that is a slow pace. The Fed's hawkish pivot has only produced a limited tightening of financial conditions so far. That is absolutely true, because we haven't got there yet. We've only just begun. We don't know anything. I mean, there's even some talking about the potential of a hike coming at this meeting. I don't think so. I really don't. I think we're going to get some more information, but I think March is the more likely circumstance. The market would just react very negatively. And then what? The Federal Reserve has to then go back? I don't think so. Real interest percentage in the S&P, and this is basically retail traders just showing us that the retail trader has lost some of their interest. Okay, that's all I'm trying to show here over the last little while. Retail gives you, sort of that euphoria behind it. What are they interested in? And at the same time, money has been flowing inward. We know this to be the case. That's been like that very distinctly from the, I would say, second half of 2020 and onward. I mean, the money's just been pouring into equities. There's been very few moments when that given week didn't have more money pouring in. The question has been more recently, where is it going to? If you look at Amazon stock, I showed you this before, AMZN, look at where it is. Let's see if my head's not in the way. It just got punished over the last couple of days. But the point here is that you see the rally that happened, okay, up in this range in here, rallying because everybody's buying things on Amazon. Everybody's freaked out. They're not going to the stores. Oh my goodness, what's going to happen to retail? And you look at this, Amazon is the next big thing. And then suddenly, oh, here we are, 2020. By the time that peak of September, early September 2020, chopping along. So we don't necessarily know what's going to happen. Where is the money going into? Well, maybe from Amazon after that big surge, it started to go to small caps. Maybe it started going into, whatever fancy name was around. But some of them just didn't do well. I could tell you, though, people have been putting more money into ETFs than ever before. People are doing passive investing, and you could look at the charts being very clear. Over the last 10 years, global flows into equity funds, trillions of dollars being put into the passives, even the mutual funds, but we're talking about passive side. The active mutual funds, people just don't want to pay the fees if they're not getting the results. What's the point, right? I get it. This is key. The number one biggest buyer is being let loose. Yet again, if you stayed into this video, here I am over 11 minutes in, and what we're talking about here is the number one biggest buyer. There's no blackout as far as I'm aware as of the time you're watching this video. So you could definitely see the corporates getting out there and throwing billions and billions of dollars into this. They may decide to refrain from that at this time, but there's no doubt, there's no denying, and the data and the facts are here for all my Money GPS subscribers to note the fact that the number one biggest buyer is here. And then March 14th, the blackout begins again. Okay, so watch out for that. Margin debt to the US nominal GDP, never seen anything like this before. So when you compare those two, I love it, not just the dollar value, but actually comparing it to the GDP, it gives you some sort of balance there. Margin debt to the available margin plus margin debit, again, highest ever. So just measuring it on different levels shows you how excessive it is. Debit balances in customers, securities margin accounts, again, a record high. Massive. Unbelievable. The risk, the leverage that people are taking today, dangerous to say the least. Is the market crashing? No. Here's what's happening to stocks, bonds, and the Fed as the Fed aims to end the days of easy money. Well, this article basically just shows you line after line after line of why everything is totally fine. Well, you make the decision for yourself. Don't read these things and think, well, you know what? That makes me feel good. And so because of that, suddenly, I like this article. No, you shouldn't do that. In fact, you should read the things that you disagree with, not the things you agree with necessarily. Okay, you need that, that real opposing force. That's why I'll selfishly say that more people should be watching the Money GPS, because all of what I do is simply to challenge the narrative. I'm the alternative. The mainstream is there. Put your money into ETFs, dollar cost average. Do you need to watch videos on that? Really? No, you need to watch the alternative, and then think for yourself, am I doing the right thing? You don't need to watch videos to make yourself feel good. You need to watch them to challenge your belief system, to make sure that, you know what? Yeah, I think I am doing the right thing. Okay, great. Okay, so I'm not going to cover the article. I think it's pretty obvious. You've seen these mainstream articles. It could be good, it could be informative, or it could be laughable. It happens. All right. Now, this is about real estate and what's happening. I'm going to cover this really quickly, and then we'll move on. City staff near New York City, Credit Suisse's in the US, to return to the office. This is big. This is very big. And I think it's very positive to the economy. Did you hear me say that? I said it's positive to the economy, okay? No matter what the haters say. This is very good because you have all of these big towers. You look at the downtown core of any of these major cities, it's banks, it's insurance companies, it's all the rest. And so you've got people coming back to work. 50-story tower. At the bottom of those towers, you've got restaurants, and you've got the little shops, and you've got places for, people to buy their suits and their shirts and their ties and their shoes, and, fast food places and restaurants and whatever. And all those places have been hurting when people are staying at home. So right now, coffee shops and all that's okay. The point is, if you got these workers coming back, you've got, all of these businesses that are suddenly going to do better. They need to hire more workers. They need to bring them back. Positive. We can hope that that's the direction for more companies. 100 offers on a single GTA, Greater Toronto Area house. Why scarce listings are further driving up the home prices. Did you hear what I said? We're talking about a regular, normal house in a regular and normal area. There's nothing special about this. You could see the example of what a typical house looks like here. You've got a little crawl space in between the two of this, detached homes that are so close together you can practically smell what the person beside you is eating for, having for dinner. And you get 100 offers. 100 offers. The prices have gone absolutely berserk. They are completely out of control. And let me tell you, this is never net positive in the long term. People think, I feel so good. My house has gone up in value. It's good that it goes up in value. You want to see that. You want that. Of course you want that. But do you want something to go in a straight up direction? Never. That's never a good thing. And it is always a concern. Always. Okay? We don't want this to happen. We want slow and steady growth. But guess what? It never does. All right. I'm going to end the video there. If you appreciate it, simply hit that thumbs up button. What are you waiting for? Don't go anywhere before you click that button down there. Have you seen this video yet? No? What's going on? You got to check it out, all right? So click it, and I'll see you there.